All right, welcome back to Know Your Risk Radio. And, our list of influential and distinguished guests, it continues today. And we're going to go around the globe just for an update. A lot of crazy stuff going on out there, a lot of changes. And I think that our guest will echo that. And since he is known fondly, I might add, in the Twitter universe world and by his blog as the macro tourist, I thought who better to have on than a good friend of the show, Mr. Kevin Muir. Kevin is a market strategist, in my opinion, the most important market strategist for East to West Asset Management, and based in Toronto. It's based in Toronto, right, Kevin?
That's correct.
Yep. And so anyway, without further ado, Kevin, thank you for joining us, and it's great to have you back.
Well, it's great to be with you again, Zach. I'm looking forward to chatting.
Yeah, well, that's what you say now. We'll see in 20 minutes or so. Okay, first things first. Where are we at? Let's kind of give me a macro rundown of what you see. We're clearly seeing a lot of the PMI and ISM numbers around the world not looking too hot. A lot of things pointed in the wrong direction, and yet we've had this. I don't know if historic's the right word, but we've had this just face-ripping rally since December 26th. So let's start first on the macro side. What do you see going on out there? And then is this rally for real? Was this just a buying opportunity and the bull market's running again?
Yeah, well, there's no doubt that the U.S. has been kind of resilient, where the rest of the market, the economy, the global economy has been one by one, we've been falling. It started in Europe, and then it eventually went to China. Even here, we're Canadian, and I noticed that our economic numbers have definitely been rolling over lately. And the real question is the U.S. Kind of just the last man standing and eventually going to also succumb to this malaise that's kind of been enveloping the world, or is there something different that's going on? And I really think that that's the question we need to be asking ourselves to determine whether this rally that we've gotten since that kind of December 24th low, is it a bear market rally, and did we in fact top last October? Or was this move that kind of the move late last year, was that merely just a kind of a correction in a bigger picture? I have my opinion, and it's I must say that I kind of feel like the global economy is entering into a recession, and that the U.S. is eventually going to also succumb to the same forces that the rest of the world has succumbed to. But you could make an argument that it really, to some extent, it's things are different in the States, and maybe there's more room to run on this rally. And one of the things that I look at is we kind of had that decline in December, and since then, when you look at the markets, with the stocks that have been leading, it's actually broadened out. No longer is it just kind of the FANG stocks leading, but you actually see the equal weighted index outperforming the S&P 500. So if you go look at the RSP ETF, which is basically an equal weighted S&P 500 index, it's up 18.2% from the low, whereas the SPY is only up 16.5%. So you could make the argument that we're actually seeing some signs that things are good, and maybe it's not as bad as everyone thinks.
Yeah, I've noticed that, and it's obviously a bit confusing to me because I'm sure, like you, we weren't exactly loaded down in the FANG type stuff, very much more on the value side of it. And I've been pleasantly surprised by the performance of some of those other stocks. Yet at the same time, still wondering, look, those stocks are, they're not going to fare well in a recessionary environment, just like the FANGs. Just trying to wrap my head around what that dynamic playing out is. Do you think it's maybe the FANGs, the index guys and the FANG lovers, they really took it to the chops there in the last 3-4 months of the year, and maybe they're branching out a little bit? Do you think we're seeing value make a comeback? What do you attribute that to?
Well, There's no doubt that value stocks are cheap. They're still not leading the way on this rally. The FANG stocks have definitely lost their momentum. People aren't rushing into kind of those 4 or 5 names anymore. Another interesting thing that I've kind of noticed is if you pull up the SPLV index, which is supposed to be a low volatility index, this thing is just running like it stole something. And whereas the S&P hasn't hit new highs, this thing has broken out to new highs. So there's no doubt that there's a lot of different kind of shifts within the market happening, and it's difficult to determine whether that's the sign that this market has more legs, or is it the sign of just the last kind of little bit that we're going to kind of see in terms of the people rushing for the few stocks that haven't yet gone up, and that's what we're seeing. I'm kind of more in the latter camp. I think that this economy is rolling over. I think you see it today with the unemployment numbers. They weren't as good in the States, and you're finally seeing some problems. And I think that we're going to look back, and it's just going to be this rally. It's going to be nothing more than a chance to sell into.
Yeah, it's hard to disagree with that take. Let me flip one around on you here. We did a segment. Did a segment last week about Boeing and Palo Alto Networks, and two completely different companies, obviously different sectors, different businesses, all that kind of stuff, different stages of growth and life cycle and all that kind of stuff. And it was probably one of the most controversial segments we'd ever done because, well, we're Seattle based, so if you say anything about Boeing, you're gonna ruffle some feathers, right?
That's right.
And we were talking about the efficacy of buybacks, and there's a lot going on, on the stock buyback debate. And I think that what I've noticed is my personal take, and I know it won't influence what you have to say, but my personal take is, look, I think it's somewhere in the middle. I think stock buybacks can be a wonderful thing. I think they can also be an absolute abomination. And when I see these companies running hot, trading at record valuations, going into debt to buy back their own equity, it's an absolute head scratcher to me. Furthermore, when I see companies like a Palo Alto Networks that's trading at, I think it's 11.5, 12 times sales, something like that, negative cash flow, going into $1 billion of debt to buy back the stock, that's even more of a head scratcher. What is your take on this whole buyback thing?
Well, I try hard not to kind of make an opinion about what should be done and just kind of focus on what will be done. So I don't try to make judgments about what, like where policy should be headed. I just try to think to myself, what is the market? Where is the market going to go because of what will be done? And when I look at buybacks, one of the things that I think that's interesting is that there's no doubt that companies have taken out a lot of debt to go out and to buy back their equity. And you've seen this, that there's record, like as you mentioned, there's record buybacks throughout and all sorts of industries. And they seem to be doing it at points that don't make any sense in terms of economics. But one of David Rosenberg, who's the famous Merrill Lynch analyst, I was at a dinner the other day, and he brought this the point up about how much of investment grade bonds have become triple B. So if you think of investment grade bonds are kind of the creme de la creme of bonds, and they're the companies that can borrow at the best rates, and that's anywhere from triple A's all the way down to triple B's. And he was noting there's been a huge trend in terms of the number of investment-grade bonds, credits that are actually become triple Bs, meaning that, it used to be that kind of 25% of, I don't know the exact numbers, but it was something like this, that 25% of, investment-grade bonds for triple B 10 years ago, and now it's something like 50%.
Yeah.
And many people hear that stat and then they use it to say, well, you got to go and you have to short investment grade bonds because this is going to cause all sorts of problems in the credit markets, and there's a disaster waiting to happen because of all these triple Bs that are going to get downgraded, and they're going to become junk. And once they become junk, they're going to basically be forced to borrow at higher rates. And his point, which I completely and utterly agreed with, and I thought was such brilliance, he said, well, imagine you're a treasurer or you're a CEO of a triple B company, and you're on the cusp of getting downgraded to junk, what is going to be your reaction? Are you going to go and enter into a big CapEx spending? Are you going to go do a big buyback? No, the answer is you're going to do everything you can to try to keep your BBB rating. So I think that's actually one of the biggest headwinds for the equity market going forward, is the fact that this number of BBB, credits in the system has never been higher, and you're going to see a cutback in terms of both on the capex side and, more importantly, on the buyback side. So I think that we're in the midst of kind of peak buyback, and that when we look back, 6 months from now or a year from now, this trend will all be headed the other way.
See, this is why we have you on. That's a great point.
I wish I was smart enough to think about that. Rosenberg came up with that. But once I heard him to say that, I was like, that's a genius, conclusion, because many people's knee-jerk reaction is to go out and go short credit and to go short the LQDs or something like that. And that's not how this thing's going to play out, in my opinion. It's going to play out through the equity market and the economy. And so I think both of those kind of reactions, as those companies are so desperate to try to keep their BBB rating, will be negative for both the economy and for equities.
Yeah, no, I'm just wondering what it's going to do to the overall business, though. Because that means they got to back away from the trough, right? I mean, they won't be able to keep bringing in capital. I just wonder. I just wonder how much how many issues there are out there, how many securities there are out there that are going to get hammered when they. Whether it's market induced or whether it's self induced, whether it's self governance that reins in that borrowing. I think it's a brilliant point by Rosenberg. I still don't know. I as a short, that short and high yield, looks attractive to me. But that's a brilliant point. That's certainly tempering my opinion for sure. And for those of us, excuse me, I'm having a tough time today. For those of you just joining us, we're with Kevin Muir here, market strategist for East to West Asset Management, and also Kevin, if people want to follow you, we can obviously go Google the Macro Tourist blog. You can find him at Kevin Muir, M-U-I-R, on Twitter. Hold that thought. We got to take a quick break, but we'll be right back with Kevin Muir on Know Your Risk Radio on AM 770 KTTH. All right, welcome back to the show, and let's get right back into our conversation. We're being joined with Kevin Muir, the market strategist for East West Investments. Another thing I wanted to bring up, because I drive a lot, going to a lot of different client meetings all the time, and I have started listening to you and Serezna's show that you're doing, and I've thoroughly enjoyed it. Thought you guys have great content. It's fun, it's informative, and you guys are getting down to business. Where can people find your show?
That's very kind of you to say, Zach. It's the Market Huddle. So markethuddle.com. It's also a YouTube show, so you can actually go there and see. We post some charts and have some fun videos, and we try to have a little more fun than some of the kind of more staid, boring finance stuff. So don't go if you're not prepared to kind of have some fun, because that's the number one name of the game there.
Yeah, absolutely, and that's one of the reasons we like to have you on too. We like to talk to guys that aren't too hung up and impressed with themselves, and just like to, get down to brass tacks. So if you're a market nerd like I am, you want some insight, some laughs, and a laid-back manner, I think the Market Huddle is a great place to go. And we can also learn about some craft beers there as well, too, right?
That's right. We do a little drinking as it's going along, so we always have a different sponsor that's and we kind of experiment with some of these Canadian craft beers. So it's been a lot of fun that way. I've never known how many different beers there are.
Yeah. No, I've really it's certainly a more laid back, enjoyable atmosphere than our show. Unfortunately, we can't.
Oh no, this is tons of fun.
But there's no libations.
No drinking though.
Yeah, there's no libations. Right. Unfortunately. Yeah. Okay, so another one I wanted to hit with you, and this isn't new. This has been going on for a little while. Gold and the dollar. I thought we were going to break trend there. It really looked like gold was, we hit 1350 and we just backed away in a hurry on the price of gold. Gold and the dollar, though, are still showing signs that they want to rally together. What do you make of that? What are your thoughts on that? What are you thinking?
So I kind of laugh because I guess it was a little less than a month ago I wrote a piece, and it was a gold bullish piece. And when I started the piece, I wrote something to the effect that I've been waiting for a pullback in gold to write this piece, because even though I'm going to give you a bullish argument for the long term, I'm still the trader in me is worried that the moment I write this piece, the gold market is going to go down. And so I was waiting and waiting, but there was no decline. So I finally bit the bullet and posted the gold piece. It was a bullish gold piece, and I only missed top ticking it by a week.
Yeah.
So it eventually did roll over. I think it went up first. And the point of my piece was that central banks throughout the world have been accumulating gold for the past 5 years at a rate that we've never seen before. And I think it's a really interesting dynamic that you're seeing, whereas the previous decade you saw central banks divest in gold. And, Canadian central bank was one of the, we were one of the worst culprits of this. We sold all our gold. We weren't quite as bad as the Bank of England, who pitched the gold into the low at $300 or something stupid like that, and marked the absolute low in the gold price. But it's been interesting to me how we can see, and you can go look at my charts, you can see the fact that central banks, like whether it be Russia or China, all these central banks are buying gold. And I'm of the opinion that if you look at gold in non-US dollar terms, like if you go pull it up in Australian dollars, it's kind of hitting new highs all the time. In Canadian dollars, it's doing pretty decently. In euros, it's doing well. I think that we have hit a point where it hasn't broken. It's never going to break in terms of its relationship with the U.S. dollar, but you will see times when it outperforms the U.S. dollar, and I think we've entered in one of those periods. So yes, on big dollar up days, you're going to see gold go down, but I still think that on the whole, if you're someone in Europe or Canada or Australia, we're going to wake up and kind of a year from now, chances are gold's going to be much higher.
Yeah, no, I'm from your lips to God's ears, pal. Gold has been a conundrum for me for, it's a hot potato, right? I mean, when it's starting to run and it makes its move, you want to be there, but it can be a house of pain for an extended period of time. And we jumped on it right at December 15th, that the Fed announcement of that last rate hike. We saw a similar setup to the end of 05, of 15 and beginning of 16 when gold made that nice rally. And then we hit 1350 and just backed away. And we just decided to kind of pull back and take a small profit. Well, much like the timing of your article came out, we did that, and then you see this bounce back we've had today, and I was just kind of laughing to myself. But what is the?
Well, I think one second, Zach. What do you? I think to answer you really have to wonder. I mean, ask yourself, what do you think the U.S. dollar is going to do? So I'm actually curious of what you're feeling. We're going back up to the high of the trend right now, or of the range, and a lot of dollar bulls are kind of coming out of the woodwork and getting all bulled up again. And I'm just wondering what you think. Do you think that we can break out to new highs? And what's your prognosis for the dollar over the next little while?
Okay, well, this is new. I've never had a guest ask me a question, but
I'm curious what you're thinking.
Yeah. Honestly, I kind of think it's a bit of a tail wagging the dog scenario in the sense that I don't think that the dollar is going to lead the way. I think that if we are headed into a global downturn, I think the dollar is going to continue its ascension, and when I say that, Brent, Santiago Capital, Brent Johnson. He and I have had some discussions about this just over the phone and over Twitter, and I see it much like he does. It was really hard for me. I was a big dollar bear after 08, 09. Part of that was inherited from where I came from and how I was raised, and went to the gold conferences, and I just remember sitting there at the end of beginning of 2011. Thank God. And saying, I don't see the inflation coming, right? It's just not showing up. And as much as that blew my mind, we backed away, thank God, big time from gold, and just didn't really touch it for the next 4 or 5 years. And I'm not, every time I say anything dollar bullish, I just, I don't get attacked, but you just ruffle a lot of feathers. And I just always want to look at those people and go, look, long term, I'm just as bearish, if not more bearish than you are. but it's a structural issue. If we're heading into an economic decline, I don't see how the dollar doesn't rally significantly. If China pumping and if the U.S. launches QE, which I think is inevitable, if they do that and they're able to float equity prices and they're able to stabilize economies, I think you'll see the dollar pull back. And that's kind of probably like a duh answer, but if we're going into decline, much like every other downturn, I just don't think this time is different. And I think the dollar rally, will probably be bigger, and it'll be bigger because of a function of how much debt out there is denominated in U.S. dollars. I can't see around that. I think Luke Gromen, the work he does, I think he's brilliant. I respect the guy immensely. I just can't get past it. The other reason, Kevin, and I think you and I were probably raised in the same school of thought, I was trained to look at these things in a way that if it can go wrong, it will. And, and I look at the world and I go, what is the biggest problem economically for the world? I mean, barring exogenous threats that you can't predict. And if the DXY goes to, 140, that's a problem. That's a big problem.
Yeah, 140. I think if it goes to 110, it's a problem.
Oh yeah, excuse me. I was thinking of the TLT. I was getting them inverted.
Yeah.
You're right.
No, because it doesn't take much, and that's I think was one of the problems that we saw. Why eventually the stock market had its kind of sell-off in December was the threats that the Fed was going to continue to be hawkish and keep rates higher and cause that pain to continue.
Yeah, no,
so I hear you, and I think it is an interesting question, and I think everyone should be watching it really closely, and it'll be interesting to see if we do get a break above this range, because we're right at the top right now, and we didn't quite break out, but will the stock market be able to rally with the dollar? And Brent Johnson from Santiago Capital, I really like his work and think it's great. The one kind of pushback that I have against him is that I don't doubt that you might get a situation where the dollar rallies. I don't think the stock market, the U.S. stock market, can go with it. And that's kind of would be my pushback to Brent.
Yeah, I think it was within an exchange that I had with you and Brent where I said, Brent's got a whole milk milkshake theory. And I'm more of a skim milk or 1% milkshake theory, because I agree with you. I'm with him. I just think if you see a spike up to 110 or God forbid 120 or even higher on the DXY, I just can't see the dollar or stocks rallying alongside. I can't picture that. Maybe some of these sin stocks, like an Altria or, that are paying, really good dividends and tend to have pretty stable cash flows throughout recessionary environments. Maybe those kind of things could catch a bid because the world is so desperate for yield. But I'm with you. I can't see the indexes levitating with DXY. Nothing's impossible, right?
Yeah, never say never. Good trader never say never.
Okay, well, you know what? That's a great opportunity for us to take a quick break. But we're going to have Kevin with us when we return, at least for a little while, so stick with us. We'll be right back. You're listening to Know Your Risk Radio on AM 770 KTTH. All right, guys, welcome back, and we're going to get right into it because we've got Kevin Muir of the Macro Tourist blog with us and the market strategist for East to West Asset Management. Sorry, I just keep tripping over that. Okay, another one I wanted to bring up to you. Because it's near and dear to my heart. I really don't know why, but volatility has always been something that I've just been obsessed with. I find it fascinating. We have not seen volatility markets return to normal since the Volpocalypse or Volmageddon or whatever you want to refer to it back in early February last year. And I thought for a second we might start seeing it getting suppressed again like it was during that period of time. And we've seen a pop up. I've got the VIX at 17 right now, or right about there. What are you noticing? Do you pay a lot of attention to vol, Kev, or do you not? What are your thoughts on that?
Well, I'm an index derivative trader, so there's no doubt that I also love volatility like you. Working at a bank, though, I spent my whole time always short volatility, so I'm not one to be kind of long. I hate the theta decay, and I was the worst long vol trader around, so I'm not kind of hoping for a move upward. One of the things that I'm watching, though, is that I contend that the next crisis won't be led from the stock market. I firmly believe that the next crisis is going to come out of the bond market. So one of the things that interests me is the fact that the MOVE index, which is kind of like the VIX for fixed income, is almost at the all-time lows.
Really?
So, yeah, and it's just, there's been no, and I understand central banks pinning kind of fixed income throughout the world, suppressing volatility. There's no doubt that should cause it to be lower than in the past. But it still strikes me to be that if you wanted to play for a problem occurring, that playing in the fixed income in the treasury market is a much better place to go than to be long equity volatility.
What is how comparable is the theta in fixed income volatility versus equity volatility?
Well, don't forget, fixed income volatility, depending on which tenor you're trading, which year you're trading, will be much less.
Okay.
So you might have stuff that's trading at like 2 or 3 vol and stuff. The MOVE index isn't necessarily an absolute kind of percentage like the same way that the VIX is. It's more of an amalgamation of different tenors, meaning different maturities. And then they just kind of put it together. But it's just kind of on an absolute basis, it's as low as it's ever been. And the same for foreign exchange volatility. It's also kind of, when you go look at that, it's also sitting at kind of not all-time lows, but it's also kind of scraping along the bottom. So although we find the situation where, maybe equity volatility hasn't gone back down to the stupid levels that we saw before the VIX the volacopalypse or whatever it's called, but we definitely have seen other asset classes, their volatilities, their implied volatilities trading much, much lower. And see, the problem about owning VIX is that even though it might seem cheap at 15 or something, I think that the realized, meaning the actual volatility of the index is running below that, and it's more like 10 or something. So, and what that means is that if you think about that, an option buyer, for them to make money on kind of trading the volatility only and just kind of taking out the bet on which way it's heading, because option traders can isolate and take out the delta, meaning the move in the actual index, and they can trade the volatility portion on its own. And what they end up betting on is whether the index is more or less volatile after they buy it at a specific implied volatility. So even though it's trading at 15 and you might say to yourself that's cheap, well, if it averages over the next 30 days only a realized of 10, then an actual professional trader could be short that kind of straddle or however they wanted to do it and earn that 5% difference.
Yeah.
So that's kind of one of the things that you need to be so wary of, is the fact that it might seem kind of cheap, but it doesn't necessarily have to be back to 20 or 25. So I really caution against owning VIX, because that, in the combination of the fact that there's such a huge carry on the way that the structure of the VIX futures, because you can't really buy VIX, as people don't realize. It's not something that's not really traded. What you're in essence doing is buying an ETF, or you're entering into a futures agreement, and what you're doing is you're buying VIX in the future.
Yep.
Anyways, it's like a derivative of a derivative kind of forward. It ends up being complicated, and the long and short of it is there's a huge carry on that. So it's something that really should be left to professionals. I think that the originator of the VIX index said he regretted ever creating it, because he said it was never something that he thought that the average person should be trading.
Oh no, I think it's an absolute widowmaker, and when anytime we touch vol, we have a rule that we won't be long vol more than 2 weeks.
I think that's a great idea. Or, one of the things that I would say is that if you are going to go buy puts on, like, let's say you were going to buy index puts, you're bearish or something, consider doing it buying like a 2750 and then selling at 20 2550 or 2600 or something, so that at least you have something that you're short on the other side that is earning, that you're earning the decay of your theta. So it doesn't end up being that your theta burn is as high.
Yeah, because it'll eat you alive. Okay,
Yeah.
while we've still got you here, I want to pack in a couple different things into this last few minutes we've got here. So I'm going to throw them quick at you. So first, we got some, even to me, some surprisingly bad numbers on the China exports. What do you make of that? News came out, for those of you that don't know, news came out last night. The China exports, correct me if I'm wrong, Kevin, but I believe they were down 20% year over year.
China.
Yeah, give us. Yeah, I want to hear what you made of that.
Well, China's having a tough time, and the real question is China having a tough time because of Trump's trade policies, or is China having a tough time because it was a self-induced slowdown? And I think that's up for debate still. And there's no doubt that Trump's policies made it harder. But I go back to Felix Zulauf, who actually brought this to my attention, the fact that they have a political cycle in China, and they have a big, huge plenum or whatever it's called, like their Congress meeting in 2021. And it's their 100th anniversary of the Communist Party. So if you're sitting there as a central planner and you're thinking about your economy, you want your economy to be running hot in 2021, just as that kind of Congress is coming in and all the big leaders are there. So you don't go and stimulate in 2019. You stimulate in 2020. And in fact, in 2018, this is when Felix brought this up, he said, the next couple of years we're going to have a slowdown from China, and they're going to be doing it themselves. They're going to be tapping the brakes on. And that's exactly what you've seen. They've clamped down on some of their corruption. They've clamped down on some of their the stimulus. Now, subsequent to the late last year, the brake ended up being too much, and they realized it was quickly spinning out of control, and they put their foot back down on the accelerator a little bit. But I still question whether this isn't something that they wanted and planned for.
Yeah.
And so when I see the export numbers, I think to myself, yeah, they're terrible, they're awful. I don't know if there's anything to do from it, though, in terms of from an investing point of view. First of all, they're in the rearview mirror, and the time to do something was kind of a year ago or 6 months ago. It's not now to say, whoa, China's slowing down really hard. It's time to go sell China. No, it's probably all in the price.
Yeah, no, I mean that's a great point. My only problem, and I don't know if you spoke to Felix. I watched that interview he did on Real Vision, and I heard. I think he said that. I've heard somebody say that before. I'm assuming it's him. And I remember thinking that's really a brilliant point. You want to be hot, just much like presidential elections here in the United States. You want to be hot at election time. And that makes sense. I just question whether they're going to be able to maintain that control over the economy. The free market guy in me just thinks that they're going to lose control. I just don't think that they can keep an iron grip on things and control all the variables in the way that they have. Do you think that they can? I mean, what is your take on that?
Well, I don't disagree. That I always remember Jim Chanos would say, this was back when it's easy to forget now, but in the early 2000s, China was the kind of what everyone was aspiring to be, and he says, how come we're sitting here and kind of lauding all these 9 men in a room dictating prices and saying that they somehow can do a better job than our capitalist system?
Yeah.
And he's always said that there's going to be imbalances and there's going to be problems, and that all they're doing is suppressing kind of the misallocation of capital is no. It's not like it's not happening. It's just not, the market isn't able to actually correct until it goes to a point where it explodes.
Yeah.
And so I think that's kind of would be your argument. I'm sympathetic to that argument. I don't know when it's going to be. Guys like Kyle Bass, he's been a huge bear. His argument is that you're going to see that as their foreign exchanges reserves are wound down, there's going to get a point where they can no longer support it, and that's what you should be watching for, is the point where they can no longer, they don't have enough foreign reserves anymore to offset the moves.
Yeah.
And he's of the opinion that it's sooner rather than later. Now, having said that, he's been that opinion for the past kind of 5 years. It's one of those things. It's not a problem until it's a problem, and then it's a big problem.
Yeah, no, it is. Okay, so final thought I want to get from you. What is the number one thing that the macro tourist himself is keeping his eye on? What is the number one thing that you're watching right now with interest, and what are you focused on?
Okay, well, it's kind of an offshoot of a trade, but we've been talking about China and we've been talking about the U.S. I think one trade that I really like is the Australian Canadian dollar, and whenever I can, I always avoid trading against the U.S. dollar because I find it's too much of this risk on, risk off, and there's kind of various different aspects going to, the political side of it, whether Trump is, doing this or that and stuff. So I try to isolate trades. And one of the things that I really believe is that China is no doubt in a situation where it's worse than the U.S. So, and I don't see them stimulating anytime soon. We still, going back to Felix's point, we're still another kind of year away before they should really put their foot down on the accelerator. So I look at it and I think to myself, U.S. is going to outperform China from an economic point of view. And then I look at the commodity currencies, like Canada's a commodity currency and Australia's a commodity currency. Mm-hmm. And when you look at Australia's number one trading partner, it's China. And then you look at Canada's number one trading partner, it's the U.S. And I think just kind of an easy trade that you should be looking at and thinking about just putting on and forgetting about because it has a nice low volatility is short Australian dollars against Canada. I think that you're going to see, we've had a housing bubble in Canada, but our bubble is nothing compared to Australia. Australia is like Canada on steroids.
No kidding.
And I think that you're going to find that whatever, problems we have from the China slowdown, Australia's going to have them twice or three times as much. And it's probably one of my favorite kind of high conviction, low volatility trades, which is short Australian dollar Canada.
Yeah, that's I hadn't heard that one before. See, this is gold. I gotta look into that one. That sounds. I'm with you. It makes perfect sense. So, anyway, Kevin, thank you so much for joining us and kind of going around the globe with us there for a little while. I always love having you on. And again, for people just joining us, they can follow you at Kevin Muir, M-U-I-R on Twitter. They can go to the Macro Tourist blog, and they can also catch you and Patrick Serezin on the Market Huddle. If they just go to YouTube and type in Market Huddle, it'll come up, right?
They'll get it for sure.
All right. Well, hey, pal, appreciate it as always. Great to have you on, and look forward to speaking to you again in the near future.
Thanks for having me on, Zach. I really enjoyed it.
All right. And you guys, thank you so much for joining us. We got to take a quick break, but we'll be right back. This is Know Your Risk Radio on AM 770 KTTH.